Then in part C, identify errors in the price earnings valuation performed by Andrew Green and explain, with the support of calculations where necessary, how the errors should be corrected. Present your answer in the following format. All right, so you can see in the first column we have the identification of the error, and in the second column we need to explain, with the support of calculations where necessary, how the error should be corrected. So you guys know from our lecture on valuations, when we are valuing a company using an earnings multiple, we calculate the value by taking maintainable earnings and multiplying by an adjusted earnings multiple. And in this scenario, we are working with a price earnings multiple. And remember, the logic is your earnings figure and your multiple must always be comparable. So if we are performing a valuation using a price earnings multiple, the earnings in this multiple are after interest and tax. So that means the maintainable earnings that we use in the calculation must also be after interest and tax. So how do we calculate maintainable earnings? We need to make certain adjustments to profit so that we can estimate the earnings that will be maintainable in the future. So firstly, what we do is we adjust for any exceptional or non-recurring items that are not expected to happen again in the future. Then after that, if there's any income or expenses that are not market related or not reasonable, we also need to adjust for that. So that this maintainable earnings figure over here includes income and expenses that are market related or reasonable. Then, if there are any non-operating assets, we should exclude any income from those non-operating assets from maintainable earnings, and instead, those non-operating assets will be valued separately. Then you need to calculate maintainable earnings for a few years in order to establish whether there's a trend in earnings or not. If there is an increasing or a decreasing trend, we'll then use the most recent year's earnings as the figure in our valuation. And remember, if there's no trend, we will then calculate a weighted average. So you'll remember in our lecture, I always tell you to perform all of these adjustments and calculate maintainable earnings for all of the years that you've been provided with in the question. And then once you've performed that calculation, you can determine whether or not there's a trend. If there's a trend, use the most recent year. If there's not a trend, we calculate a weighted average. Then after we've determined maintainable earnings, we need to multiply that by an adjusted price earnings multiple. Now, the reason why this is an adjusted multiple is we perform this valuation using the price earnings multiple of a similar listed company. And we are trying to calculate the value of a private unlisted company. Now, there are obviously going to be differences between the similar listed company and the private unlisted company. So we have to adjust for those differences. You can't just use the multiple of the similar listed company as it is. So over here, we need to adjust for entity level differences between the companies. We will then take maintainable earnings after interest and tax for the private unlisted company, multiply that by the adjusted price earnings multiple, and that will give us the value. However, your calculation doesn't stop there. Once you have this value over here, you then need to adjust for owner level or shareholder premiums and discounts. Alright, so we haven't yet actually started answering the required. This is just an overview of how the valuation of Bulletin should have been performed. We can now compare this to the valuation that was performed by Andrew Green. We can then identify errors in his calculation and then explain with the support of calculations where necessary how those errors should be corrected. So only now are we actually getting on to answering the required. This was just my planning. Obviously, guys, you need to know how the valuation should have been performed before you can identify errors in the valuation. Now, you don't necessarily have to write all of this out. As long as you know all of this and all of this is in your head, you would have been able to pull out the errors in the valuation. So this is just the thought process that you should have gone through. I've written everything down because obviously it's a little bit easier when I'm trying to explain everything to you. So let's go to Andrew Green's calculation. He valued the total company at 59,377,500 Rand. And he performed the calculation by taking Bulletin's current year profit. So you'll remember this is the current year profit from the statement of profit or loss and other comprehensive income. So he took their current year profit and he multiplied by a price earnings multiple of 4.5, which is the price earnings multiple of a similar listed company. So let's break his calculation down into the two components so that we can discuss each of them separately. Let's first look at the current year profit which he has used in the calculation. We know that that's incorrect. You can't just take the current year profit and use that in the calculation. If we go back to our discussion over here, you'll remember that the current year profit needs to be adjusted for exceptional or non-recurring items, income and expenses that are not market related, and the value or any non-operating assets should be valued separately. Now in this scenario, we were not given any information relating to exceptional or non-recurring items, so there's no adjustment necessary over there. We do have an expense that is not market related. You'll remember that the directors agreed to take salaries that were 20% less than market related salaries in both years. So we do have an expense that's not market related, and we therefore definitely need to adjust for that. So that's definitely an adjustment we'll need to make. And we also have a non-operating asset that should be valued separately. We valued the investment. Remember, they have an investment in Stationery Suppliers Limited, and we calculated the market value of that investment in Part B of the required. So that investment over there is not an operating asset. It's got nothing to do with their normal operating activities. It's a non-operating asset. It should be valued separately. So the dividend income over here, which is included in profit for the year, should be excluded, and instead that investment should be valued separately. So that's definitely an adjustment that we're going to have to make for the investment in Stationery Suppliers Limited. And when we make these adjustments, we won't just make the adjustments to the 20x6 year. We've been provided with information for 20x6 and for 20x5. So we will perform these adjustments and we will calculate maintainable earnings for both of the years so that we can establish whether or not we have a trend in earnings. Now, he has at least used the correct profit figure. He is using profit after interest and tax in his calculation. So you'll remember we said the price earnings multiple and the earnings figure must always be comparable. So this earnings figure must be after interest and tax. He has done that correctly at least. He is using earnings after interest and tax. However, we do need to use both years in the calculation. We do need to adjust for the directors' salaries that are not market related, and we also need to make an adjustment for that dividend income because the investment in Stationery Supplies Limited is going to be valued separately. So if we jump to the suggested solution, first you need to identify the error. Now, terminology is very important here, guys. You don't need to discuss the error. You are just identifying the error. So just state what the error is. What is the mistake that he has made? Don't discuss that mistake in detail. So the first mistake that we identified is profit for the year, which he is using in his calculation, includes directors' salaries which are not market related. You then need to explain how the error should be corrected. So let's first look at the explanation and then we'll support the explanation with calculations. We know that he should not just be using profit for the year in his valuation. Instead, maintainable earnings should be used in the calculation. And when we calculate maintainable earnings, we always need to adjust for any income or expenses that are not market related. So now we need to support that explanation with a calculation, showing how the error should be corrected. So obviously we are going to start with profit after tax for the year. So we start with this profit after tax figure over there, and then we need to adjust for the expense that is not market related. So the director's salaries are 20% less than market-related salaries in both years. So that means the market-related salary, let's look at the maths logic behind this. Market-related salaries will be 100%. And they've agreed to salaries that are 20% less than market-related salaries. So the amount that is being expensed is 80% of a market-related salary. Now, we need to expense the market-related salary, the full amount. So what we need to do is, remember guys, the maths logic is you always multiply by what you want and you divide by what you've got. So if we look at the calculation for 20x6, we know that director's remuneration in 20x6 is 10 million rand. So we need to multiply by what we want. What do we want? They've only expensed 80%. They need to expense an additional 20% so that the full amount is expensed, so that we expense the market-related salary, 100% of the cost. So what do we want? We want this 20% over here. We want to calculate the additional amount that should be expensed. So we multiply that by 20 and we divide by what we've got. What have we got? We have the director's remuneration that was expensed. We have 80% of the cost. So we divide by 80. That's going to give us the additional amount that should be expensed, the extra 20% that should be expensed, so that we expense a market-related cost, so that we expense 100%, because they've only expensed 80%. All right, so there's the adjustment for 20x6, and you apply exactly the same logic to calculate the adjustment for 20x5. then you just need to be careful. We are starting with profit after tax over here. Now, because we're starting with profit after tax, we need to consider the tax consequences of any adjustments that we make. Now, the company will get a tax deduction for directors' remuneration or for salaries that they pay. So when Bulletin prepares their tax return at the end of the year, they will get a tax deduction for the director's remuneration. So, because they will get that tax deduction, we need to take into account tax on that adjustment. So you just take the adjustment in each of the years and you multiply by 28%. As an alternative, you could have just taken the adjustment and multiplied by 72% so that you process the adjustment after tax, and you'll get exactly the same answer. So either take the adjustment and multiply by 72%, then the adjustment is already after tax and you won't need to show the tax on the adjustment separately, or you show it separately. I recommend rather showing it separately, guys, just in case you make a mistake, because more often than not, this is a consequential mark which is awarded for using the correct tax rate. So it's better to rather show it separately. All right, then the next error that we identified is profit for the year includes dividend income. Or as an alternative, you could have said that the investment has not been valued separately. So how should this be corrected? The dividend income should be excluded from the calculation of maintainable earnings, and the investment should be valued separately. Let's then show the calculation. I'm starting my calculation here with profit after we made the adjustment for directors' remuneration. So this is the starting point in my calculation. And we need to exclude dividend income in each of the years. So we have dividend income of 250,000 Rand in 20x6 and 225,000 Rand in 20x5. That needs to be excluded. And then remember, guys, you don't need to worry about a tax adjustment over here because dividend income is exempt for tax purposes. They won't be taxed on dividend income. So there is no tax adjustment necessary over there. All right, so that then gives us maintainable earnings. Then you'll remember we said you should calculate maintainable earnings for a few years to establish a trend. And if we don't have a trend, a weighted average should be calculated. So another mistake in Andrew Green's calculation is he has only used the 20x6 profit in his calculation. So the valuation is based on 20x6 earnings only. How should this be corrected? Maintainable earnings should be calculated for a few years to establish a trend. If a trend cannot be established, a weighted average should be calculated. So, now let's apply this to the scenario. We can see over here, after all of our adjustments, we have a decreasing trend in maintainable earnings. So because we have a decreasing trend, we are going to use the most recent year as the maintainable earnings figure in our valuation. Now, it's actually very hard to determine whether or not you have a trend when you are only working with 2 years information, because either the earnings are going to increase from one year to the next or they are going to decrease. So either way, you're going to conclude that you have a trend. So ideally, you actually need to be working with more years in order to establish whether you have a trend or not. However, in this scenario, we only have 2 years of information. So you're forced to work with what you've got. There is a decreasing trend in earnings, and therefore the 20x6 maintainable earnings figure should be used in the calculation. All right, now we can move on to the adjusted earnings multiple. If we look at Andrew Green's calculation, he has just used the multiple of a similar listed company. He has not adjusted for entity level differences. So that's another error. I've given you a list of the entity level differences that you always need to consider. Now, you need to go through that list and consider whether you have a difference that needs to be adjusted for. Remember, you can only adjust for known differences. So we are trying to look for differences between Bulletin, the company that we are trying to value, and the similar listed company. Now, you have been specifically told that the similar listed company has a national footprint, so they operate across South Africa, and they specialize in print and online media, packaging, and label printing. Now, if we look at Bulletin Express, Bulletin Express publishes, prints, and distributes newspapers and magazines in Gauteng. So the first difference that we have that needs to be adjusted for is Bulletin Express is obviously a lot smaller. They are only operating in Gauteng, whereas the similar listed company has a national footprint. They are operating across South Africa, so they're a lot larger. The similar listed company also has a more diverse product range, where they have print and online media, packaging, and label printing. Whereas on the other hand, Bulletin Express focuses on print media only. The similar listed company will also have easier access to finance because they are listed. It's much easier for a listed company to raise new finance than a private unlisted company, so it will be more difficult for Bulletin to raise new finance. We did identify that as a negative factor, so that's another difference that we would need to adjust for. Then finally, we also need to adjust for the fact that Andrew Green is going to retire, and he is one of the founders and the current CEO of Bulletin. So when he retires, there's going to be a loss of expertise. So that must also be taken into account. So the next error that we identified is the price earnings multiple has not been adjusted for entity level differences. How should this be corrected? Well, the price earnings multiple should be adjusted for entity level differences between the two companies. So between the similar listed company and Bulletin. What are the differences that we should adjust for? Bulletin is smaller and based in Gauteng only, whereas the similar listed company is larger with a national footprint. Bulletin has limited access to new finance as an unlisted private company, whereas it's easier for the similar listed company to raise new finance. Bulletin has a smaller product range. They are involved in print media only. On the other hand, the similar listed company has a more diverse product range. They are involved in print and online media, packaging, and label printing. And then finally, we have loss of expertise when Andrew Green retires because he's one of the founders and the current CEO of Bulletin. Now guys, all of these factors over here are negative from the perspective of Bulletin. The fact that Bulletin is smaller and they are in Gauteng only. The fact that they have limited access to new finance because they are not listed. The fact that they have a smaller product range, and the fact that they are going to lose expertise when Andrew Green retires. All of those are negative factors. So because all of those are negative factors, we need to decrease or reduce the price earnings multiple. So we take the price earnings multiple of the similar listed company, which is 4.5, and we need to adjust that multiple downwards as a result of the above differences. So you can then conclude on what multiple would be more reasonable. So I've concluded that a multiple between 2 and 3 would be more reasonable. Now guys, as long as you have a multiple that is less than 4.5, you can award yourself the mark over here. This is a consequential mark, but it shouldn't be 4 because then you're only adjusting by half. You need to at least adjust for the 4 differences that we identified above. So what I normally say is always just adjust for 1. So start with 4.5 and then adjust for 1, adjust for 1, adjust for 1, and adjust for 1. But the problem is this price earnings multiple is already quite low. So that's going to bring us down to 0.5. So what I did instead to make this more reasonable, because that's obviously not reasonable, is I just adjusted for half each time. I felt that that was a more reasonable adjustment. So that will bring me down to a multiple between 2 and 3, which would be a lot more reasonable. So to complete the valuation, we need to take the maintainable earnings figure, multiply that by the adjusted price earnings multiple, and then adjust for owner level or shareholder premiums and discounts. Now, that's obviously another error in Andrew Green's calculation because he has not adjusted for owner level or shareholder premiums and discounts. So that's the last error that we need to discuss over here. The final value calculated has not been adjusted for owner level or shareholder premiums and discounts. So when we talk about owner level or shareholder premiums and discounts, we are talking about control premiums, minority discounts, and marketability discounts. So let's first just quickly jump to the calculation, and then we'll discuss whether each of those are applicable in this scenario. So what we do is we take the maintainable earnings figure, which we calculated from above, and we multiply by our adjusted price earnings multiple. And I'm using a multiple of 2.5 to get the company value. Then, guys, just remember, when we calculated maintainable earnings, we excluded dividend income from the calculation because we said the investment should be valued separately. So because we excluded the dividend income over there, once you now calculate your final value, you need to include the market value of the investment in the calculation. So that's the next step over here. Include the market value of the investment. And we have already performed the calculation, so you can just bring the market value from part B of the required and include it over here. And that is a consequential mark. So as long as you include the market value that you calculated in part B of the required, you can award yourself that mark. Then finally, we need to consider the owner level or shareholder premiums and discounts. So let's first consider the control premium. Do we need to add a control premium to this calculation? If you go back to the scenario, we know that Andrew Green currently holds 5% of the shares in Bulletin. And we are obviously performing, or he's performing this valuation from his perspective. He wants to know what his shares are worth so that he can sell them because he wants to go and retire in Mauritius. So we definitely won't add a control premium to the value that we've calculated because we are not valuing a controlling interest. Then you need to consider whether a minority discount should be deducted. Now we are valuing a minority shareholding. He only owns 5% of the shares in the company. It is a minority shareholding. However, you'll see in the suggested solution, I am not deducting a minority discount. Why am I not deducting a minority discount? Remember, guys, we've used the price earnings multiple of a similar listed company to perform this valuation. And in the question, we are not told whether this multiple over here reflects control or not. So if the question is silent, meaning we are not told if the multiple reflects control or not. Then it is safe to assume that the multiple does not reflect control. So what is the logic over here? The question is silent. We have not been told whether this multiple of 4.5 reflects control or not. We don't know if it reflects control. So because we don't know, the question is silent, we are going to assume that it does not reflect control. Why are we making that assumption? This is the multiple of a similar listed company. Guys, the whole reason why companies list is so that they have access to a lot of shareholders who want to buy shares in that company. So normally listed companies don't just have one majority shareholder. Listed companies normally have a lot of small minority shareholders. So that's why it is safe to assume that this multiple does not reflect control, because it is the multiple of a similar listed company, and normally listed companies have a lot of minority shareholders. So it's safe to assume that this multiple does not reflect control, which means the value calculated over here does not reflect control. So you can't deduct a minority discount because this value that we've calculated does not reflect control. So if you deduct a minority discount, you'll be double accounting for it. You should only deduct a minority discount if this value that we calculated does reflect control, but you are trying to value a non-controlling interest or a minority interest. So if this value does reflect control and you are trying to value a minority interest, then you would deduct a minority discount. However, this value does not reflect control. So you can't deduct a minority discount because then you would be double accounting for it. Then finally, we need to consider whether a marketability discount should be deducted. And if we are valuing a company where the shares lack liquidity, so in other words, it's more difficult to sell the shares in the company because the company is unlisted or it's a private company, then you should deduct a marketability discount. So Bulletin Express is a Pty Limited, a private unlisted company, so we should definitely deduct a marketability discount. So a marketability discount should be deducted to reflect the share's lack of liquidity because Bulletin is an unlisted private company. So if you look at the calculation below, you can see I am deducting a marketability discount. I am deducting a discount of 10%. You've been given the ranges in your lecture notes, so please use the ranges in your lecture notes, but you can deduct a marketability discount between 5 and 15%. And that then gives us the total company value. Now guys, you don't need to multiply that by 5% to get the value of Andrew Green's shareholding. He didn't value his 5%. He calculated the total company value. So we've just discussed the errors in his calculation of the total company value. You don't need to say that it's an error he didn't multiply by 5%. He would obviously take this total value and multiply it by 5% in order to get the value of his shares. But one problem that we can see over here is the company value that we've calculated is a lot lower than the value that he calculated. So let's hope he gets enough money out so that he can buy that house in Mauritius that he wants. Alright, so that's what I was looking for in part C of the required. Guys, don't get intimidated where you have a discussion type question instead of a straightforward calculation. It's not more difficult. It's only more difficult if you've studied from questions and you've learned how to do things from questions and you don't understand the principles behind the calculation. If you understand the principles that I went through up front behind the calculation, then you shouldn't struggle with a discussion type question. You apply exactly the same logic. Okay, so that then deals with part C of the required.